Hello and welcome to the Weekend Investing special episodes on market moves. We are now witnessing a sort of a correction, and as on 4th of October, as we shot this video, Sensex was already down a few percent, 5% from the top, and maybe by the time you see this video, the crack may get harder. Now, the pattern of these videos is essentially data-backed analysis. So we will go back and analyze a lot of data, try to get insights from that. There is no prediction in these studies. We cannot say what will happen. Can never say that. But the idea is to study the past, get confidence from the past moves, get probabilities from the past move, and condition our mind to accept the market and go forward. That is the whole idea. If you are looking for, what will be the point at which market turns, how deep will we go, how quickly we will recover, and exact forecast of that, I don't waste the next 15 minutes of your valuable time watching this video because that is not the outcome of this video. Now let's get in and see what we have to showcase to you. So this is the situation as on October 4th. Uh, my sense is that maybe uh, we may go down to August lows maybe by mid of October. That's my best guess. Could be worse, could be better. I don't know. So the panic has started somewhat, little bit, and most of the folks who are panicking or are having started to panic are those who have probably never seen falls or are still new investors, have seen one or two falls only. And there's a lot of war news going on, there's a lot of uncertainty about US election news going on. So there is enough on the plate to confuse one mind as to how things will go ahead from here. So the question that we want to answer first is, why is a correction important? So if we see the last 4 or 5 years, which have been very unusual years, post COVID especially, we had first the COVID crisis in 2020, and then there was a very sharp recovery which went on till third quarter of 2021, and then there was a lull for a year and a half, and then we built on that base and have reached where we are right now. So only one 18% correction came through since 2020 March. Markets have gone up 61% since that correction. And there is not much of experience for people who have entered in this time frame besides that one major correction. So should we expect another, largish correction? 10 to 15% is what we can call a significant correction. And then beyond that, maybe 20-25% is a deep, very deep correction. And beyond that is like, event based collapse. So if a event like COVID happened, we collapsed 35%. In the GFC crisis, we collapsed 70%. So beyond 25% is not, you can say, normal anymore. Then anything can happen. You know, if we go beyond 25, I think it is an exceptional case which will happen maybe once in a decade or maybe even more. Uh, so the normal course of things is, the sweet spot, if you may call it, is 10 to 15%. So if we were to correct 10%, we will go from 86,000 Sensex to about 77,000. If we correct 15%, we will go to near 73,000. Now, the first point is very near the election day high. So election day high also is a great support point. And the second 15% correction is somewhere in the thick of this, 5-month consolidation that we got. And that can also provide us with great support areas. So both these points, even from a numerical as well as from a practical historical perspective, provide you with some sort of context that these are good places to maybe even add money and look for reversals in the market. So we've analyzed all 10 to 15% type of corrections in the last 30 years. We've not considered above 15% for the reasons I mentioned earlier, that they are very, very specific to that particular event, and they basically distort the normal correction data. So while they can happen at any point of time, is a special event can happen, but they are not the normal corrections. So post 1994, last 30 years, we had these 8 major 10 to 15% kind of corrections, and we've not had, you know, a major correction or a 10 to 15% correction since 2019. The one we had in 2021, we have not considered this in this particular study. So now if we go back, the first case that we took up was in 1999, where we had a market fall of nearly 15.9%. And it was a very swift fall. In 18 days, the market fell almost 15%. And then in 81 days, we were able to recover this entire amount, more than 2 months or so. We recovered the entire thesis, the entire fall. Then the next one came in March 2005. Uh, this was a sort of a coordinated global correction along with other emerging markets. So we lost 11% over 42 sessions, and then quickly recovered in about 104 sessions back to previous highs. Next one again came in 2005. We fell 13%, 24 days. This time the recovery was reasonably fast. Within 52 days, we were at a new all-time high. Then for the next year and a half, for two actually, there was not much of correction, and we had a 15% correction in Feb 2007. This was also backed by other global markets falling at that point of time. And within 25 sessions, you fell 15%. You consolidated after that, and 144 sessions later, you were at a new all-time high. The next one came very quickly in July 2007, 11% fall, 28 sessions down, 57 sessions up, and you again were at an all-time high. From 2007 then till 2018, there were no average corrections. I mean, there was no 10 to 15% kind of correction, and we fell 10% in 2018 in 53 sessions. So the first drop is always very fast and then it shallows out. That is the usual trend. And then there is 164 days of recovery, getting back to a new all-time high, post which again there was a correction in September of August, September of 2018, and we again fell 14%. So imagine 1 year where you fell down, you came back up all the way, and then you fell again, and then you came back up all the way in the next 6 months or so. Our duration of fall was 59 sessions, and then there was a gradual recovery going for 217 type of days. And then, of course, there was 2019 when again 10% fall was there, and you recovered over 154 days. Fall of duration was 108 days. So on average, if we were to average and bunch up these similar kind of corrections, so there could be smaller corrections which we have not taken, and there were larger corrections which were not taken for the reasons mentioned. And this is the sort of typical correction that will come through, a good correction that will come through. About 45 days or about 2 months of trading is what will essentially be the max pain period. That for 2 months, I mean, you're praying every day that the market turns, and it doesn't. And then about 122 sessions of recovery. So maybe about little more than 3 months. Sorry, almost 6 months of recovery time in terms of coming back to an all-time high. Now, also to study what happened before and after these corrections. So to get the context right as to were the markets really flying before the large corrections. So the two times when we had nearly 15% correction, 6 months before that fall, you had 46% gains and 33% gains on the index. And there were others where you also had 30% gains and 33% gains, and you fell 11 to 12%. So most of the times you had, some great gains before you fell amazingly. And these four times from 2017, 18, and 19, you really didn't go up as much, but you fell reasonably well. So from the point of view of 2007 onwards, we've had these corrections which were, which would take away pretty much what you made in the previous 6 months. If you see 1 year before the fall, there were several years where you did extremely well before this fall. 2 years extremely well, many of the years were extremely good, and 3 years also in some cases, where the before you dipped into these corrections, you had a great run. So that if you were invested for 1, 2, 3 years, these falls would not really take away all your gains and only, sort of peck at your accumulated profits, so on and so forth. And now to see what happened after these falls. So 6 months after this fall, you had modest gains. So essentially, after the fall, it did not really, go up like a V-shaped recovery in most of the cases, where there were also cases where even 6 months after the first fall, you were down by 21%. 1 year after the fall, for instance, in this case, you were still down. In other cases, you came back up. And 2 years after the fall, you had, three instances where you were down, but two or three instances where you really, really did well. So not much of correlation can be made out of some of these data points. But the fact remains that, most of the times post these falls within a year or so, you did recover fully, and you also made some gains beyond that. So the average gain, if I were to say, beyond these corrections within 6 months was 18%, 1 year was 28%, 2 year was 35%, and 3 years was 53%. And prior to these falls, you had these gains also. So if we see the current context, prior to this fall starting, I mean, we've had substantial gain in the last 1 year and 2 years. So we can potentially, lead to these averages going forward. So I know this data will not real it cannot really convince you to do any specific action, but the fact remains that whenever markets fall, we tend to think of the worst, and we a lot of folks probably, stop looking at the markets, or will not invest more, or will withdraw from the market. That should not be the case, because you need to understand that to go forward, market has to go one step backward also. Every time it goes forward, it will take a one step back, and it will go forward. Fortunately, we are in a market where for the very long period of time, last 30 plus years, we have been marching forward. And for the next 20, 30 years, it is likely that the same will continue. Each time there's a shakeout, each time there's a correction, a lot of weak hands will move out of the system, and hopefully the stronger ones will sustain. And when the market comes back up, it is that point where most weak hands restart to think about the market, that, oh, we made a mistake, we got out at the bottom, now we want to come in at the top again. And that cycle repeats for a lot of people. So you can't make money if you are investing, once the recovery has happened and getting out at the bottom. Obviously, you are gradually eroding away your capital. So the idea should be that you stay in the market. Don't try to time the market if you can't. There are some extreme, I would say, just short of magical brains who are able to time it to the T. Nobody else can do it. So if you are not that magician, don't try that. And even with not trying to time the market, not trying to move in, move out. See, because you have to see one thing is that, let's take the index. The index in the last 20, 30 years has performed at 13% or so, roughly. It has not moved out of the market at any point of time. It has gone to the entire depth of 71% correction also. It has gone to the highs, it has gone to the lows. So if your portfolio never got out of the market, but still did better than the index, then you will make more than 13% returns. So you need to have that conviction that the strategy that you're following will beat the index. You don't need to get out, just follow the strategy, and you will survive, and you will make a lot of money. At every point of time where you will try to cut corners, you will try to uh, you know pull a smart one on the market, that I know something which the market doesn't. All this smartness doesn't work in the market in the long term. Once or twice it may work out, but usually it will not work out. So don't try anything funny, don't try anything which is unusual. Just follow the market, continue with your plan of SIPs or investing more at gradual times, continue with following your strategy, and you will be doing extremely well at the other end. That's the message for this video. And the impact of SIPs during correction, we have shown in several videos how massive that impact can be if you are able to gradually bring in your money while the market is down. So regardless of where you start, if you are bringing in your money gradually, you will see the impact of more units or more small case units being added at the bottom, and that will really give that kicker to your portfolio. So let me know your thoughts on the corrective move in the market and how you deal with it, and how you are, in case you are faltering from that resolve, how to deal with it. What are the key things that you're looking at in terms of how to improve and how to motivate others how they can improve their sipping as well. Thanks. I'll see you in the next one. Bye.